If you're a business owner pulling up your financials and thinking to yourself, what am I even looking at? You're not alone. I've talked to so many business owners who have been exactly in your shoes. So in this video, I'm going to walk you through exactly how a CFO reads a P&L, a balance sheet, a cash flow statement, and how you can too. Once you know what to look for, these reports become a little bit better for decision making and not just reports that your accountant sends you every single month. If I haven't met you yet, I'm Roman, founder of Full Send, and we help $1 to $10 million businesses build smarter financial functions. So after working with hundreds of founders, I can tell you, those that understand their financials, they tend to make sharper and faster decisions. So I want to help make sure that you become one of them. So in this video, we're going to walk through 4 steps on how to understand and how to read your financials like a CFO. So step 1, you have to know what each statement is telling you. So generally, you've got 3 standard financial statements: your profit and loss or your income statement, your balance sheet, and then your statement of cash flows. So on your P&L, starting with the income statement, this is really charting out your total revenue, the money that's coming in, and then the money that you're spending out, your total expenses, to drill down to like, how much money are you actually making? So as you're reading your P&L, this should be telling you, are you profitable and why? Where is your money coming in from and where is it going out to? And then what's left over? Looking at your P&L ultimately is going to help you drive understanding of profitability to make better revenue and or expense decisions. When you look at your balance sheet, the big theme here is, what do you own? What do you owe? And how healthy is your business financially? So what do you own? What are your assets? Do you have cash on hand? Do you have accounts receivable? Do you own fixed assets, machinery, equipment, things like that? From an equity standpoint, how much equity exists in the business that you own today? When you move to the cash flow statement, this is really just kind of connecting the dots, saying, how is your money actually moving? Because generally, profit doesn't equal cash. You can look at your income statement, you can look at your profitability or net income, but that may not resonate with how much cash you have on hand. So the statement of cash flows is designed to help you understand how your money actually moves. Now, step 2 in this process, we need to talk about what a CFO actually looks for, the monthly scan that should be taking place. So in your profit and loss, you want to be looking at your gross margin trends. So when I talk about gross margin, I mean your total revenue, total income, minus your cost of goods sold. So how much money did it take you in physical product, in time and materials in order to generate that revenue? So we're looking at margin trends. We're also looking at year-over-year or month-to-date expense drift. How are our expenses changing in those time frames? What does the variance month-to-month look like? And is it sounding off any alarms that we should be aware of? And then lastly, we want to look at our net income, or if you're in a capital-backed environment, EBITDA swings. Your earnings before interest, taxes, depreciation, and amortization. So when we look at the net income swings, we're trying to understand, is this a result of margin elasticity? Meaning we can deliver a higher amount of revenue on the same amount of cost? Or is it due to swings in expenses that are happening? That'll help you understand how much net income is changing in your business. On the balance sheet, what we want to be looking for is spotting unusual account balances. So really any negative balances on your balance sheet is a red flag. If your accounts receivable is negative, if you have a bank account that somehow is displaying negative, maybe it's your aging AR and AP. We've got negative balances in both of those things. Those are red flags that identify some type of an accounting error. We also want to look at any unusual movements in owner distributions. Maybe there were personal expenses that were taken in the business that should have been or were classified as owner distributions. Those are going to be some things to look for on the balance sheet. Now, from a statement of cash flow perspective, we want to identify whether the operations, your investments, or financing are driving changes in cash. So are you putting money back in the business? In AR, is your AR balance or AP balance fluctuating from an operational standpoint? Are you investing money in fixed assets and or machinery to generate future revenue? And or are there financing elements, notes payable, things like that are driving the change in your cash balance? Identifying those things will help you start to think about your financials through the lens of a CFO. So step number 3, what questions should you be asking when reviewing your financials? All right, why is my net income growing but my cash is staying flat? Maybe I should look at the statement of cash flows to help me understand where the cash is going. Why is payroll higher than last quarter's? Was it a payroll tax issue? Was it a benefits equation? Was it that I hired additional folks and my wages went up? You understand what's happening with payroll, particularly if you're in a professional services business. You want to understand accounts receivable movements. Are my customers paying on time? Or are my AR days outstanding creeping up, meaning that you've delivered services, you've sent the invoice, but your collectability is just lagging. It's taking time for you to bring that cash in. That may be an indicator that you should change a process in your accounts receivable collections process to be able to start collecting that money more effectively. Lastly, if you have an inventory-based business, is your inventory turning over fast enough? Is your cash conversion cycle enabling you to continue investing in the business? Meaning, as soon as you deploy money for inventory, how quickly can you turn that into money on the sales side of taking that inventory and shipping it out to a customer? Those are some questions that I'd be asking myself when looking at financials for my business. So last step here, step number 4, what are red flags to look for as a CFO? What are some mistakes that founders often miss? So high revenue, low cash. Hey, that might be indicative that there are AR issues, collectability issues, or perhaps you're overspending in certain areas relative to your budget or relative to how much revenue is coming in the door. So if you've got high revenue, your cash balance just feels a little constricted, you should think about how cash is being collected and or spent in the business and or how you're setting cash aside for future spend. Things like tax payments. You need to make an estimated quarterly tax payment. You should be setting money aside for that, earmarking it so that it does not get spent on something else. Another red flag that comes up is negative balance in assets or negative balances on the balance sheet. That is generally indicative of an accounting error. Now, if that is true, there's likely a corresponding error on the P&L or somewhere else in the financials. That's an indication to me that generally you can't trust the financials because they're not accurate. Something to take a look at. Another red flag would be no changes in key accounts. Key accounts that should be moving like AR, AP, inventory, should be moving on a regular basis. If it's not, that usually means that there's stale data or a broken process that enables you to have quality and consistent financial reporting. The last thing that we've seen in looking at many companies' books is that there's an unusually large balance in the Ask My Accountant category. That's always a red flag because that just generally means that somebody has no idea how this should be categorized, thus throwing off the quality of the financial statements. That is a big red flag. So if you can read your financials a little bit more like a CFO, you can make decisions faster, you can spend smarter, you can sleep better at night. You just start with one statement. Start with your P&L and build from there. If you want a little bit more information on that and want to dig in more on like how should I think about my business like a CFO, head to our website at thefullsend.com and or feel free to reach out to us at howdy@thefullsend.com. Happy to help you, happy to provide some resources to you to help you understand your financials a little bit better so you can elevate your outcomes and create a more sustainable business.